Part 1. Why market crashes are inevitable. Why do market crashes happen? And more importantly, should investors really fear them? History shows us something very important. Market crashes are not rare accidents. They are a natural part of the financial cycle. Markets rise, markets fall, and then they rise again. If we look at more than 100 years of market history, we see this pattern repeating over and over again. There have been multiple major crashes throughout history. Some of the biggest include the Great Depression crash of 1929, the dot-com bubble crash in 2000, the global financial crisis in 2008, and the COVID crash in 2020. Different causes, but the same outcome: a major market correction. One of the biggest mistakes investors make is believing the phrase, "this time is different." But markets have a way of proving that idea wrong. Just like a pendulum, markets swing back and forth. Boom, correction, recovery, and then growth again. In fact, after every major crash in history, markets eventually recovered and went on to reach new all-time highs. Which leads to the most important lesson investors should remember. The market rewards long-term thinking. The real question isn't, will there be another crash? Because history suggests there will be. The real question is, are you prepared for it? Smart investors don't try to predict the exact moment of a crash. Instead, they prepare for it. Because when the storm comes, preparation makes all the difference. So how can investors prepare? By learning to recognize the warning signs. And historically, there are three major signals that often appear before large market downturns. Let's start with the first one. Part 2. Warning sign number 1. Extreme market valuations. The first warning sign is extreme market valuations. In simple terms, this happens when stock prices grow much faster than company earnings. Imagine a scale. On one side, you have stock prices. On the other side, you have company earnings. When the market becomes overheated, the price side becomes far heavier than the earnings side. Another way to visualize this: imagine a giant skyscraper labeled stock prices standing next to a tiny building labeled company earnings. That imbalance often signals that the market may be overvalued. One of the most widely used tools to measure this is called the Shiller P/E ratio. This metric compares stock prices to long-term earnings. When the ratio becomes extremely high, it often signals that the market may be entering dangerous territory. Historically, very high Shiller levels appeared right before major crashes. For example, before the dot-com crash of 2000, and again before the financial crisis in 2008. In both cases, valuations reached extreme levels, and soon after, the market corrected. Today, some analysts believe valuations are again reaching historically elevated levels. That doesn't mean a crash will happen tomorrow, but it may suggest we are late in the market cycle. Which brings us to the second warning sign. Part 3. Rising interest rates. The second major signal before market downturns is rising interest rates. Interest rates represent the cost of borrowing money. When central banks raise interest rates, borrowing becomes more expensive. Companies pay more to finance operations. Consumers borrow less, and spending across the economy begins to slow. Another important effect involves liquidity. Liquidity simply means how much money is flowing through the financial system. When central banks tighten monetary policy, they effectively turn down the liquidity faucet. Less money flows into markets, and historically, when liquidity dries up, asset prices often struggle. Higher interest rates also create competition for stocks. When safe assets like bonds begin offering better returns, investors sometimes move money away from equities. This creates a chain reaction: higher rates, less borrowing, less spending, less liquidity, and eventually, pressure on stock prices. History shows that many market downturns occurred during periods of rising interest rates. Which leads us to the third and final warning sign. Part 4. Extreme investor optimism. The third warning sign is excessive investor optimism. This usually happens near the end of long bull markets. When markets rise for many years, confidence grows, and eventually, confidence turns into overconfidence. You begin hearing phrases like, "stocks only go up," "this time is different," "you can't lose in this market." These are classic late-cycle signals. When everyone believes the market will keep rising forever, that's often when risk is the highest. Eventually, the market runs out of new buyers, and when there are no buyers left to push prices higher, even a small trigger can cause a large correction. History shows that markets rise slowly, but fall fast. Confidence builds gradually, but panic spreads fast. Part 5. What smart investors are doing right now. So what should smart investors do when these warning signs begin to appear? Instead of panicking, they follow a few key strategies. The first strategy is building cash reserves. Having cash available gives investors flexibility, because when markets fall, opportunities appear, and investors with cash are able to buy assets at discounted prices. The second strategy is focusing on quality companies. Strong companies with solid balance sheets, stable earnings, and global leadership tend to survive economic storms better than weaker companies. Think of them like sturdy houses during a hurricane. While weaker structures collapse, strong companies often remain standing. The third strategy is diversification. Smart investors spread their money across different asset classes: stocks, bonds, cash, real estate, and sometimes global markets. Diversification helps balance risk. When one investment struggles, another may remain stable. Together, these strategies create a more resilient portfolio. Part 6. The long-term mindset. Another critical rule successful investors follow is simple: think long-term. One of the biggest mistakes investors make during crashes is emotional selling. Fear takes over, markets fall sharply, and many investors panic and sell at the worst possible moment. But history consistently shows that time in the market beats trying to time the market. Markets recover, they always have, and often the best investment opportunities appear during the deepest downturns. In fact, many fortunes have been built during market crashes, because while most investors panic, disciplined investors quietly accumulate assets. They plant seeds when prices are low, and over time, those seeds grow into powerful financial trees. Part 7. The big opportunity. A major market crash always carries two sides: risk and opportunity. While many investors focus only on the danger, experienced investors also recognize the potential. Because when fear spreads across the market, prices often fall far below their true value. And that's when disciplined investors step in. They buy when others are fearful, they accumulate assets when others are selling, and they prepare for the next cycle of growth. Final message. So remember the three warning signs we discussed: extreme market valuations, rising interest rates, and excessive investor optimism. These signals don't predict the exact day of a crash, but they can help investors understand where we might be in the cycle. Instead of trying to predict the future, focus on preparation, because when the next market reset arrives, prepared investors won't just survive, they may be positioned to benefit the most.